Good day, everyone. How are we all doing? You're all welcome to my YouTube channel, and today we're going to be looking at the trades that we took on the 21st of May 2025, which was a wonderful day. We closed in massive profit on gold. So I sent the signal to the group right here. You can see it, the signal to the group right here. Look at that, sell gold now, stop loss. So we had to change our stop loss a bit because of the market volatility. We changed the stop loss. We didn't put the stop loss at the right point, so that's our stop loss right there. And look at that, finally in profit. So we just kept on going like that, and look, the market just kept on pushing to the downside. And look at this, over 290 pips, over 290 pips to the downside. Like I said, over 290. Yeah, we actually were able to actually secure about 230 or so, 230 pips. You can see it right here. Can you see it? So look at that, beautiful trade right there, beautiful trade right there. You can see it. So also we sent a trade signal on EJ, a limit orders. We actually had to set our limit order because we missed the entry. So we set the limit order. Market did not come back to activate our limit order, which was really sad. You understand? It was really sad. So let's get into the video. Let me show you how we're able to catch this wonderful trade today on this wonderful trade on gold. So let's go into the video. So how were we able to catch this trade on gold? Very simple stuff. So what I did was simple. So I knew that gold was actually gold was bullish, you understand, to the upside. I knew that gold was bullish to the upside, and market was pushing all the way to the upside. So what I did was I actually saw this sweet break of structure to the downside on the 10 minutes time frame. So there was a break of structure right there, though it didn't close below, but it's still a break of structure if you consider it. So that's a break of structure right there. And when according to my concept that I trade, you understand, when market creates a break of structure, the eye of that break of structure becomes the passive, right? The eye becomes the passive because that eye has met its target already. You understand, that eye has met its target. So what is going to come back to come and take out that eye is the aggressors. So right here, right at this eye right here, right at this eye, we have the passive, right? So these guys are called the passive because they are sitting right there. You understand, right there, they've met their target. Where's their target? This is their target. They've met their target already. So this is the passive. Now who are the aggressors? These are the aggressors. So I know that this is the aggressor, this is the passive. So what I'm waiting for is I'm waiting for the market, the aggressors I was waiting for the aggressors to come and take out the passive, which they did. So aggressors came and then they took out the passive right there. So as you can see, they took out the passive right at that particular place. So now when aggressors comes to take out the passive, they should be what we call divergence. You understand? When there is a divergence, that simply means there is an absorption, right? There is an absorption. An absorption has happened in that case, and market is looking to go in the opposite direction. But when there is no divergence, when there is convergence, instead of divergence, there will be what we call expansion. You understand? When the market expands to in the given direction, in the sense that it expands more to the upside in this case. So right here there was what we call there was absorption, right? And how did we know that there was absorption? We check for the coordinates. So what are the coordinates at this particular eye right here? We knew that they are still within the same day. You understand? They are still within the same day, but not within the same 4 hour window. So I had to check for the coordinate of this one 4-hour window and the coordinate of this other one 4-hour window. So let's check. This is 1 p.m. We can do the eye that was formed there on the 15 minutes is 1 p.m. So let's check for um so the start of the 4 hours of 1 p.m. will be 12 o'clock, which is 000. So you can see it. So you can see this is the 12 o'clock candle, and you can see it's open with a buy opening range. So that's the buy opening range. Now this one that took out the eye, which is the candle, the aggressors that took out that eye, that took out that passive, it's the candle is 545. So what is the 4 hours under? What's 4 hour is 545 under? It is 4 o'clock. So let's go and check 4 o'clock candle. What is the opening range of 4 o'clock candle? So as you can see on the chart here, opening range of 4 o'clock candle is a sell opening range. The opening range of the passive 4 o'clock is the opening range of the passive for the 4 hours passive, which is 12 o'clock, is a buy opening range, and then the opening range of this guy right here, which is 4 o'clock, which is the aggressors, is a sell opening range. So you can see there's a divergence. They are not aligning together, they are not the same, they are different. So that is the divergence. So that simply means that absorption is taking place, right? So now the next thing you want to do is you want to check the hourly opening range, right? Because they are different in hours, right? So you want to check the hourly opening range. That's the lowest you can go hourly, right? So at least there must be two. You must be checking two. It's only in some few cases that you can only use hourly to verify your coordinates if there's an absorption or exhaustion. But most times when market wants to reverse, use at least 4 hours and 1 hour. So now let's check the hourly opening range. So in this case, this is the candle for the passive is exactly on 1 o'clock. So as you can see, that passive candle, we took out the eye of the previous candle, and look at that, that's the buy opening range. Now the one for the aggressors, which is 545, so that should be 545 candle under 1 hour should be under 5 o'clock, right? So 5 o'clock is a sell opening range. So 5 o'clock is a sell opening range. So when we saw that, we knew that okay, full absorption has taken place already. Full absorption has taken place. So what we want to look for is we want to look for confirmation, right? That's the next thing. We want to look for confirmation, which is very, very simple. So our confirmation is we want to first of all, what I did was I first of all confirm this eye first, this eye, to see if it was a good eye. So what I did was I went down to, I think, 9 minutes 9. So I went down, so I confirmed that eye if it's a good eye in the sense of volume order flow. Is that eye the eye for is that the eye where institutional traders were involved in, or just ordinary traders? You understand? So that's why I had to confirm that. So I confirmed that eye is a good eye. So now let's confirm our trade. This is 53.63. So there's a money transfer right here. So that was what actually made us to enter that trade. So that money transfer has shown us that the institutional traders are coming in already to start selling. So what I did was I used my Fibonacci to get my stop loss. Very, very easy way to get stop loss. Just the candle that confirm your entry, just stick from the low of the candle to the eye of the candle and use it to look for your stop loss. It's very, very easy. So I cancelled that, and this was where we entered because we entered late, so we entered around here. So around this particular place, you can see it's very, very clean. Market, to show you how perfect this particular tool is to use for stop loss. Sometimes market, if you use normal, you just choose your stop loss randomly, market to come back and hit your stop loss and still go in your direction. But with this tool, it will give you the exact stop loss, the exact right stop loss to use. Yes, I don't need to shift, you don't need to reduce or increase the stop loss any longer. So now after that, you can see the market came, market was just dancing around before market moved all the way to the downside. So you can see that volume. Now where was our normal target? This was our normal target. So this low is our normal target, right? This one here, which is the new passive. That's the aggressor's low, which is the new passive. Now, one thing I know is that um, market will always, so look at it, market did not come to this low. Why the market did not come to this low, I don't know. But one thing now, the reason why we actually took partials here is because market will always create different lows before that low. If in a case whereby there is no low like this inside this zone before market took out that high, the market did not create any low like this, then we'll be targeting this one as a real target, right? But as market created a low before breaking that, the high of the passive, this low, market might take out this low and then reverse all the way to the upside. So this low, you mark it out, always mark it out. When market takes it out, you break, either you break even and take partials, or you break even, put your stop loss at entry, and you wait for market to take out the main target. You understand? So it's just like that. So for me, yesterday I just said, okay, this is a wonderful trade. I actually closed around here, which was around you can see 250 pips. So there's no difference. This one just 300 pips. So I just closed, and yeah, you can see market went back and take us out at break even. So that was a wonderful trade, wonderful street trade right there. So the one on EJ2, so this was EJ. So I saw this beautiful trade on EJ yesterday. So you can see market took out this high right here on EJ. So this high right here is a passive, high, right? Because this is the low of the high, this is the low of the high, this was the previous major low. Market used that low to create this high, and then market took out the low that created that high, right? So that high becomes the passive because this high has met its target already. This high has met its target. So remember, we bought from this particular low all the way up here, you understand, to meet this passive high, to take out this passive high. So we use this low right here as our passive, and then we actually took the buy from here to meet this target, which is this high. So this passive right here, this new passive now has met its target already. So this one becomes a passive, right? And then this one that is coming from here becomes the aggressor. So when market takes out the passive, this previous passive, this high, right, met this target and take out this particular, you know, this high is a major high, this is the major high, right? So market took out the major high, so we confirm that high is a good high. Yeah, to us it's a good high, it's not high. Yeah, so the traders that were trading, they were true institutional traders, not ordinary traders. Now next thing I did was I looked for the coordinates of this high in relation to this particular high, if there was an absorption or if there will be an absorption, or if there will be an expansion to the upside. So what I did was I simply went down to check, okay, what is this high was formed which time, and this high was formed which time. So this high was formed on the 20th of May 2025, which was I think on Monday or so. Yeah, if I do my math, no, I think that was on Tuesday, right? On Tuesday. And this one was formed on Wednesday, which was 21. So they were formed in 2 different days. So what I did was I look, that means if their interval is in the interval between the passive and the guys that are coming, which is the aggressors, if the interval is 1 day interval, that means we're going to be looking for the opening range of the daily, right? The opening range of the daily from the passive and the aggressors. So let's look for the opening range of the daily from the passive and the aggressors. So this is the passive right here. What is the opening range? You can see 20th is just there. Opening range is the buy opening range. Now for the aggressors, what is the opening range? Opening range is 10 o'clock. This is 21. This is 21. So you can see what is the opening range right here is a sell. So there is a sell opening range. So you can see they are diverging. This is a buy, this is a sell. So they are diverging. That means absorption is taking place little by little. So let's go down to the 15 minutes. So on the 15 minutes, we can see is there that is 4 hours, 4 hours opening range. So 4 hours we go down to the 15 minutes. So for the 15 minutes, what is the opening range? Opening range on the 15 minutes, which is this one opened, this high was formed 12:15, right? So the opening range, the 4 hours under it should be 12 o'clock, right? So this is 12 o'clock. So the opening range is a buy opening range. This one was formed exactly 10 o'clock, 10 o'clock. So the opening range for 10 o'clock, the 4 hours, 10 o'clock will be under 8 hours, 4 hours, right? 8 hours. So now 8 hours, I say 8 hours, 8 o'clock, you understand? 8 o'clock is a 4 hours candle, so it should be under 8 o'clock. So what is the opening range of 8 o'clock? 8 o'clock is a buy opening range, buy opening range. This one also right here is a buy opening range. So when you see that there's no divergence there, because the coordinates on the 4 hours are the same. So when you see this particular stuff, don't look for trade yet, don't trade yet. What you need to do, you need to wait till the market gives you a new 4 hours, and that new 4 hours, the divergence is different, the participant is different from that of the passive. So that's why we waited, and we waited for 12 o'clock. So 12 o'clock gave us a sell opening range, as you can see here. 12 o'clock, which is a new 4 hours, gave us a sell opening range. So that was diverging that of the passive, which is this guy. It was diverging the 4 hours of the passive. So next thing we want to do is we want to look for the hourly, right? We want to look for the hourly opening range before market comes up. We want to look for the hourly opening range. So where's the hourly opening range? So this is 12:25, so it should be under 12 o'clock. So 12 o'clock hourly opening range here is a buy opening range. Why this one is 10:10. You open as 10 o'clock 10 minutes, and the opening range right here is a buy opening range. So we're looking for a sell opening range right here, but it gave us a buy opening range at first. So let's check for 11 o'clock, 11 o'clock, which is the next hourly. So the 11 o'clock gave us a sell opening range. So everything is confirmed now, and that was why we actually had to set our limit order at this particular place, waiting for the market to come and take out our limit order. But unfortunately, market did not come to take out our limit order. That I told my my subscribers to my channel, they should close their limit orders right there. You understand? So where was our first target? Our first target was this low right here. Why is this our first target? Because this was the major low that market, this was the low that market formed before taking out the passive. This was the last low that market formed. If you can see, this is the last low that market formed before taking out the passive. So when the market comes to take out that low, something might happen. There might be a spike to the upside that will take out this high again, or market might just gently go down and meet the overall target. So this low right here becomes our first target, right, where we are going to be taking partials or breaking even. So no, that break even is very, very important. You break even, or you break even. So after you break even, if you want to take partials, maybe the profit is enough, you can take partials or take full profit. You understand? So market later came back to take out this passive right here, and I've not analyzed it yet to show you, to know why market. So market came back to take out this passive, and I know that something happened right there. That's why markets went all the way to the downside. So if I check where, I know that yeah, something happened right there. So that's why I actually missed the trade. So you can see it, boom, all the way to the downside. Simple stuff. You understand? So that was how yesterday's trading actually went. That was how yesterday trading actually went. So you can actually join our free signal, our free Telegram channel, where we drop these signals, and you can see every trade we drop. We explain every trade in our YouTube videos. You understand? So please make sure you subscribe, like, share this video to your friends. You understand? And just when you subscribe, make sure you turn on the notification bell so that you can keep on receiving these videos and understanding how to milk the market in a more mechanical way. You understand? How to understand every movement in the market why is the market moving in so direction, so that you can improve your skill. You understand? Not just trade the market from a guesswork or just draw lines and think market will come hit this line and sell or buy. No, trade the market from a point of mechanism, you understand, of mechanism, right? You don't trade the market in a mechanical, sorry for my English, in a mechanical way, right? So that when you take a trade, you know the reason why you're taking that trade. When you take a trade, you know the reason why you're taking the trade, and you know the direction where that trade is going to go. You know your target, you know your first target, you know your second target. All those things are important as a trader. You understand? So thank you very much, guys. Thank you for staying to the end of the video. See you guys tomorrow. Thank you.